Inflation is the biggest problem facing our economy today. You guys are all feeling it. You go to the pump, you go to the stores, the cost of goods and services has risen. Now, the Fed's trying to address this problem by tightening the economy and hiking the Fed funds rate. By the end of this episode, you're going to understand where wholesale inflation is, and we're going to take a deep dive at the Fed minutes that were just released, showing you the inside psyche of the Fed at their last meeting. But first, a couple quick reminders. If you want the best insights in the mortgage and real estate space every day, check us out at mbshighway.com. And if you're interested in investing in the crypto space, or you already are and you want the best insights and you want an edge, check us out at CryptoCharged.com. Use code Habib for a 40% discount. Hey, everybody, and welcome to the Dan Habib Show. I'm your host, Dan Habib. Let's jump into some of the news that we got earlier today. First off is the Producer Price Index Wholesale Inflation Report. Now, this is important because costs that producers face, they have two options. They can eat those costs and reduce margins, or they can pass them off to the consumer. So this can translate to consumer inflation. When we look at that PPI report, it was for the month of September, and it rose on a month-over-month basis by 0.4%. That was double the expectations. They were looking for a 0.2 rise. Now, the year-over-year number, because of comparisons from last year, it did decline from 8.7 to 8.5%, but still remains elevated. The core rate, which is even more important, strips out food and energy prices. That rose by 0.3% last month, which was in line with expectations, but year over year, it declined slightly from 7.3 to 7.2%. But here's the bottom line. Inflation, especially on the producer level, still remains way too hot, and that can translate to hotter consumer inflation. Now, we know the Fed is fixated on trying to curb this rapidly rising inflation, and they are dedicated to doing so even at the expense of the markets or the economy. And we just got their Fed minutes. This is for the last Fed meeting that we saw on September 22nd. So 3 weeks after the Fed meeting occurs, you get what's called the minutes, which gives you a deep dive look into the psyche of the Fed and what was really discussed there at the roundtable. And what we saw is that the Fed said inflation is still way too high. Obviously, we know that, and it's coming down slower than they had anticipated. What a big surprise. But many of the Fed members said we need to continue hiking to have more of a restrictive stance, meaning we need to try to slow the economy down even more so than we're doing. And they said even at the expense of the labor market slowing. Now, we haven't seen that happen yet. Unemployment rate at the last jobs report was 3.5%, which matches the low that we saw before the COVID recession that we had. So it's still very low, and this gives the Fed the cover to continue hiking. However, one thing that I thought was interesting is you did see a few of the Fed members start to express some concerns that we need to calibrate our future tightening and our future hikes because there could be adverse effects to the economy, to the asset market. So you're starting to maybe see some of the resolve of some of the Fed members start to diminish just a little bit. We'll have to see how long the Fed can keep this up and keep talking tough. So far, we've seen the equity markets obviously decline, but we haven't seen the overall economy show too many cracks. The labor market is still strong. So I believe this sets the table for a 75 basis point hike on November 2nd, and we'll see where the Fed goes from there, and we'll see where the numbers come out. But remember, the big report that we're getting is the Consumer Price Index report. I think that this is going to be a tough report to get past. I think it's going to be tough for both the equity markets, all the risk-on markets like cryptocurrencies, as well as the bond market. But here's the good news. The good news is that when we get past this September reading for both the Producer and Consumer Price Index reports, when you get to October, which we'll get in November, so we'll be getting this next month, the comparisons from last year get much, much tougher on a consistent basis going forward. You add to that we have the Fed who's continuing to hike. And remember, when the Fed hikes, it's not like you feel the impacts fully through the economy the next day. If I was sick and I went to the doctor and I got a prescription, 5 minutes later, I'm not going to be dancing on the table celebrating. It takes time for this to impact my immune system. No different here. Fed hikes could take anywhere between 3 to 6 months to fully be realized in the economy. So there's many people out there saying, hey, maybe the Fed's going too far without seeing the impact. Almost like if you're in the shower and you turn the hot water on really hot, takes a little while to finally get hot, but then you're scolding yourself. This could be what the Fed is doing with the economy currently. So a lot of people criticizing that the Fed's going too far, too much, but we'll have to see how this shakes out, team. But we'll be back to report on the Consumer Price Index for you. But the bottom line is this. I think that while inflation is very high right now, when you fast forward to the end of the year, and then especially the first half of next year, I believe you're going to see inflation come down by meaningful amounts each month as the impact of the Fed hikes is going to start tightening more on the economy, and the comparisons from last year get much, much tougher.